Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. Today is February 23rd, 2026. This is Brent Foster, and your host of the Northbound Wealth Podcast and founder CEO of Northbound Wealth Management. Weekly market insights, Supreme Court rules against the White House tariffs. So what I want to announce is, obviously you're listening to this, but listen to the Northbound Wealth Podcast on Apple, Spotify, YouTube, anywhere you listen to podcasts. The S&P 500 index rose 1.1% this week, led by communication services, as investors digested changes to U.S. tariff policy amid a Supreme Court ruling. The S&P 500 index advanced 1.07%, ended Friday's session at 6,909.51. Still, the weekly gain, which came in just 4 sessions as the market was closed on Monday for President's Day, wasn't enough to move the market benchmark into positive territory for the month. The S&P 500 is down 0.4% for February, but up 0.9% for the year. The NASDAQ Composite Index, which is the tech-heavy index, rallied 1.51%. The Dow Jones Industrial Average inched up 0.25%. The MSCI EAFE Index, which tracks developed overseas stock markets, rose 0.75%. And so what does that mean? That means the S&P 500 one-year trailing number is up 13.11%. NASDAQ is up 13.84%. Dow Jones is up 12.58%. And MSCI EAFE Index is up 32.38%. International is certainly outperforming over the past one-year trailing number. Thank you, Y-Charts, for that information. So the focus is on tariffs and technology. U.S. President Donald Trump said on Friday he will sign an order imposing an additional 10% global tariffs under Section 122 after the Supreme Court invalidated his reciprocal tariffs imposed under the International Emergency Economic Powers Act. He said, quote, "We are also initiating several Section 301 and other investigations to protect our country from unfair trading practices," end quote, Trump wrote in social media post. The developments came as official data showed U.S. economic growth was well below Wall Street's expectations in the final 3 months of 2025 as federal spending contracted due to the longest ever government shutdown. Real gross domestic product rose at an annual rate of 1.4% in December quarter, the slowest pace in 3 quarters. The consensus estimate was for a 2.8% growth, according to a Bloomberg survey. A delayed release of economic data also showed U.S. consumer spending growth unexpectedly held steady in December, while Federal Reserve's preferred inflation metric accelerated more than Wall Street's estimates to 3% year over year. Communication services had the largest percentage increase of the week, climbing 2.3%, followed by gains of 1.7% each in consumer discretionary, industrials, financials, and technology added 1.5%. Energy and real estate also eked out small gains. Omnicom Group led the gainers in communication services, jumping 21% as the company reported Q4 revenue above analysts' mean estimate and unveiled a $5 billion share repurchase program, including $2.5 billion under an accelerated buyback. Omnicom also maintained its quarterly dividend rate. Garmin shares led the climb in consumer discretionary as the company reported fiscal Q4 pro forma net income per share, as well as net sales above analyst expectations. Garmin also forecast 2026 pro forma earnings per share and revenue above the street's view at the time. Shares rose 16%. Deere, or John Deere, was the top performer among industrials, climbing 9.9% as the company reported fiscal first quarter earnings per share and net sales above analyst means estimates. On the downside, consumer staples fell 2.3%, followed by a 0.6% decline in healthcare and a 0.5% loss in utilities. Materials also edged lower. Walmart was among the hardest hit stocks in consumer staples, falling 8.1%. The retailer fiscal Q4 adjusted earnings per share and revenue slightly surpassed analyst mean estimates, but its guidance ranges for fiscal Q1 and fiscal 2027 adjusted EPS or earnings per share came in below the street's views. Let's see. I've got charts of the week. If you check out my blog, I have those listed out there, and I'm going to cover those here in the podcast. And I'll just list the 5 that are up ahead as you listen to this podcast. First is going to be the JP Morgan Asset Management Guide to the Market, slide 16, which is the S&P 500 annual returns and intra-year declines. The second's the MAG 7 versus the S&P 500 index, cap weighted, versus the S&P 500 index equal weighted, 2026 year to date performance basically for those indexes. Number 3 is software stocks versus semiconductor stocks this year. And then the fourth is growth stocks versus value stocks, and the Fed funds rate versus inflation. So go out to the blog, check out the chart pack that I have within that blog release, the latest one released moments ago today. All right. This week, key economic data. Monday, factory orders. Fed Governor Christopher Waller speaks. Tuesday, S&P Case-Shiller Home Price Index will follow in. The housing market's doing. Fed Presidents Austin Goolsbee, Raphael Bostic speak. Fed Governors Waller and Lisa Cook speak. Wholesale inventories and consumer confidence data comes out. Wednesday, Richmond Fed President Tom Barkin. He's going to be giving some comments. Thursday, weekly jobless claims. Friday, producer price index for January, and construction spending November and December. And so we're getting more and more of that economic data coming out in lag, obviously. This week, notable companies reporting earnings. Tuesday, the Home Depot, Constellation Brands, American Tower Corporation. Wednesday, NVIDIA, Salesforce, TJX, Lowe's, and Synopsys. Thursday, Intuit, Monster Beverage, Dell Technologies, Warner Brothers Discovery. Friday, Berkshire Hathaway. And just a thought on how companies are reporting earnings. A lot of them are reporting really well and doing well. So aside from the software company stocks and the AI fears disrupting those companies, things look like they're shaping up to be a good year, and they're guiding pretty well also. So tax tip of the week. Owe the IRS any money? Here's how you pay. If you owe federal taxes, you may be required to pay by the April deadline. Remember, if you get an extension to file your taxes, payment is still due by the April deadline. You can still set up a payment plan if you can't pay the full amount you owe now. Here are some choices for making your payment. You can use direct pay. The IRS direct pay is free and a secure way to pay directly from your checking or savings account. And you can pay by debit or credit card. If you don't want to link your bank account, you can use a credit or debit card. Remember, you have to pay a processing fee and may incur interest charges on that. Pay when you e-file. So if you file your federal tax return electronically, you can pay directly from your bank account using electronic funds withdrawal. And remember, this information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. Got a good show for you. Lots of information, covering a gamut of information. So stay tuned for the next segment. Hey everybody, this is Brent Foster, and I thought we'd go over HALO stocks. That's the newest and latest acronym. HALO, H-A-L-O stocks refer to a 2026 investment theme focusing on companies with heavy assets and low obsolescence. This investment strategy, popularized by Josh Brown of Ritholtz Wealth Management, highlights companies with physical, tangible assets that are not easily disrupted by artificial intelligence or AI. Key characteristics of HALO stocks are heavy assets, companies that own, operate, or maintain significant physical infrastructure, machinery, or tangible products. An example of that is energy, materials, logistics, or manufacturing. Low obsolescence is these are products or services essential to daily life that are not expected to be replaced or rendered obsolete by AI advancements. AI resilience. Okay, instead of being threatened by AI, these firms may benefit from AI by improving efficiency in their extensive operations. And then rotation strategy. The HALO trade serves as a rotation away from high valuation AI technology stocks into more stable cash generating sectors. Examples of HALO stocks are Generac. So they make generators, FedEx, transportation logistics. You could say that about UPS as well. Caterpillar, machinery, or John Deere, for example, too, is another one. Walmart retailer. Amazon is another one that's even bigger than Walmart. ExxonMobil Energy, okay, or Chevron, for example. Rio Tinto, BAE Systems, Texaco, mentioned in the context of the FTSE 100 Halo stocks. The idea is the Halo theme emerged earlier this year as a defensive strategy against a feverish pitch of disruption fear caused by AI, allowing investors to find refuge in undisruptible companies. It often acts as a counter trade to the Magnificent Seven tech stocks. I'm of the thinking that not all companies are going to be completely obliterated or annihilated by artificial intelligence. I think that you're going to see winners and losers across the spectrum. Companies that decide to work with AI are only going to be better protected against being completely annihilated. And most of our economy actually is not artificial intelligence. So if you look at all the different sectors of the economy, there are software companies that are definitely going to be disrupted, that specific area, but not all of them. Some harness AI and actually are AI software companies. Think about that. So you'll hear Halo, I think, from now on, so long as artificial intelligence is a thing. So get ready and get used to this Halo effect. All right, stay tuned for the next segment. Hey, everybody, this is Brent Foster. I just want to go over the Mortgage News Daily release. I just got an alert from regarding the 30-year fixed mortgage rate, courtesy of Mortgage News Daily. It's at 5.99%, so it's slightly below the 6% rate. 30-year FHA is 5.63%, 30-year jumbo loan 6.29%, 7/6 SOFR ARM 5.4%, 30-year VA is at 5.65%, 15-year mortgage rate is at 5.60%. So mortgage rates dip back into the fives, and the coverage is coming out earlier than normal due to a more interesting headline than normal. The average top tier 30-year fixed rate fell back to 5.99%, matching levels seen only briefly back on January 9th, 2026, when the Fannie Freddie bond buying plans were announced. Much like last time, there's always a risk that something happens to prompt a bond market reversal today. If that happens, mortgage lenders could raise rates in the middle of the day. But unlike last time, mortgage rates have eased down to current levels in a much more gradual and, dare we say, sustainable way. After all, today's improvement is only a moderate 0.05% versus Friday. Back on January 9th, the initial day-over-day jump was more than 0.20%. There's no new news causing the improvement. The broader market has gradually improved to the best levels since November of last year, and the mortgage-backed securities market, the bond market that directly dictates mortgage rates, have performed better than normal versus broader market due to Fannie Freddie purchases. As always, keep in mind that the 5.99% is a top tier average among multiple lenders. This means that for a scenario with a high FICO, high down payment, and no other hits to pricing, various lenders will be quoting 5.875, 6%, and 6.125% predominantly. Also keep in mind that many rates are quoted with different levels of upfront costs. There's no way to assess the strength of a rate quote without knowing the rest of the upfront costs. So there's plenty of disclosures that go with that. This is just me talking about where things are at. The 10-year Treasury note today is at 4.033%. So keep that in mind. It's all interesting if you're looking at trying to do a refi. Stay tuned for the next segment. Hey, everybody, I'm going to put out a slide on the blog release today. JP Morgan's Guide to the Markets, slide number 16. And I've been following and reading all the data that they put out on the Guide to the Markets, Dr. David Kelly's team, since I started actually at JP Morgan, and I learned about it in 2009 when I worked for JP Morgan. One of my first onboarding classes actually at Polaris Center in Columbus, Ohio, was Dr. David Kelly coming in and speaking to us about the Guide to the Markets and how they approach research and things like that. It was very impactful in my life. But This slide is slide number 16, annual returns of the S&P 500 in intra-year declines. So what this slide dictates is the S&P 500 intra-year decline, okay, intra-year, think of January to December, and the calendar year returns. So despite average inter-year drops of an average of 14.2%, annual returns were positive 35 of the last 46 years, okay? This data is from FactSet, Standard & Poor's, and JP Morgan Asset Management. And returns are based on price index only and do not include dividends. Intra-year drops refers to the largest peak to trough decline during the year. Returns are shown are calendar returns from 1980 to 2025, over which the average annual return was 10.7% for the S&P 500. And again, past performance is no guarantee of future results. Data is as of January 30th, 2026. So the chart shows the price return and the maximum drawdown of the S&P 500 in each year since 1980. Despite significant intra-year declines, the S&P 500 has finished the majority of years with positive returns, encouraging investors to stay the course. So, for example, let me pull up last year. So last year, the S&P 500 finished the calendar year with a return of 16%. During the course of the year, however, the market was down actually 19%. So think about that. It started out the year, let's say, at zero, if you're going to measure it that way. It went down 19% in April due to the tariff tantrum that happened when Trump was rolling out tariffs in April. Okay, so it was down 19% at the intraday low, actually the lowest mark of the year, and then it finished the year up 16%. That's quite some volatility. That's quite a swing. But investors were rewarded for staying the course and sticking to their disciplined long-term strategy. Okay. And so far this year, we've had a 3 to 5% decline, and we're about flat on the year, slightly down to where the year started. So we're maybe up 1% and things like that. So this year's still playing out. But if we go back the prior year, this was in 2024, we had an 8% intra-year decline, but we finished the year up 23% in the S&P 500. In 2023, the market finished up 24% and had a 10% decline intra-year. In 2022 was a really rough year for everything, stocks, bonds, everything. The equity markets, the fixed income markets. So the year was actually down 19%, and at the trough was down 25% at the worst for the S&P 500. So it finished the year down 19, but had an intra-year decline of 25%. And in 2021, the market was up 27% and only had an intra-year decline of about 5. Okay. And then in 2020, of course, the COVID year was down 34%. I recall that in about 16 trading days, the beginning of the year when COVID was happening in 2020, the market declined 34%, but finished the year up 16%. Okay, so the S&P 500 can have quite a lot of swings. But if you look at the hard data and historical returns, it's up 35 of the last 46 years, despite the average intra-year decline of 14.2%. And the S&P 500 over that same time frame has annualized returns of 10.7%, not including dividends. So add back the dividend and you get an even higher rate of return. So anyway, staying the course, have a disciplined strategy. Those are the S&P 500 is composed of the largest 500 companies in the United States. All right, that's your chart of the week, food for thought segment on the podcast, as well as putting it out there on the blog. So check it out, www.northboundwealth.com. Hey everyone, I want to talk about a few charts here. The first is going to be the Magnificent 7 versus the S&P 500. So how's the Mag 7 doing versus the S&P 500 and the S&P 500 in terms of total return and the weighted index, cap weighted index, okay? So as we know at the S&P 500. And then there's the equal weight. So it takes all the 500 companies and it weights them equally versus a cap weighted index. So let's see year to date how the Mag 7 is performing. Year to date, the Mag 7 collectively, the largest 7 companies in the tech space that we talk about quite a bit on this podcast, is down 5.17% year to date, according to Whitechart's chart as data as of right now, February 23rd, 2026. And then the S&P 500, the cap weighted index, is basically flat, up 1.10% as of today. And then the equal weight, get this, if you weight out equally all 500 components, it's up 6.59%. So you see an outperformance from the equal weighted index over the cap weighted index and well over the Magnificent Seven. So what does that mean and what does that communicate? Well, it means that the market is broadening out away from the concentrated Mag 7. More money is flowing, or more acquisitions or purchase orders are being made in the components that are actually making up the rest of the 493. So that explains why the Mag 7 is down. The S&P is flat because the S&P 500 cap weighted index, which is what we know as the index for the S&P 500, most people know it as that, has about 35% weighted towards technology. And what makes up the Mag 7? Well, mostly tech and the big cap tech. So the hyperscalers. So as money's moving out of that and broadening out down through the, I guess, what would represent the economy, the 493 stocks, it's actually holding up the market, doing quite well. And then the equal weighted index is actually outperforming by a lot, 1,100 basis points or so. And what that means is if you equal weight them all out, you're getting more participation from a broader subset of components within the index. So that's actually really healthy for the broader economy, I think. As money is coming out of some of the Mag 7, it doesn't mean it's going to continue. That there could be a reversal in that, but I want you guys to understand that. And I'm going to try to get a chart of that out on the blog release today. The next chart I want to go over is the S&P 500 value versus growth. So year to date, value is up 4.35%. So value is outperforming growth. Growth is down 1.71%. Now, for a long time, growth has outperformed value, and you see kind of a reversal at the beginning part of this year, which also does explain the prior chart I just went over. There's more of buying in names that are halo stocks, which I talked about earlier. That's the new acronym. Anyway, I think that's really good and interesting to see. I don't think that value is just going to always outperform, but it could. We don't know. We have to wait and see. But growth companies are kind of flat this year. It's interesting, or slightly negative. Okay, now I want to focus in a little bit on software. They've been absolutely annihilated. So software companies, the exchange traded fund iShares Expanded Tech Software Sector ETF, ticker symbol IGV, is down 27.33% year to date. That's getting crushed, basically, because of the fears of AI disrupting that entire space, which it is. But it's not, it's like baby out with the bathwater. There are companies in there that are not, are really being unfairly punished by the sell-off in software stocks or software names. This chart shows and depicts that particular ETF against the SOXX. That particular index is the iShares Semiconductor ETF, and it is one that the majority of my clients own within portfolios. It's the semiconductor space, so it's not software, but if you compare the two, that index, the SOXX, is up 17.75% year to date. So you see this like bifurcation that's happening. You see software getting crushed at down 27.33%, and the semiconductor space up 17.75% this year. And this is only just the end of February. So based on that particular basket, it's obviously better to be in the semiconductor space. And thankfully, I don't have a lot of folks allocated to the IGV in the software space. It's been under pressure for quite some time, actually, just not this year. And the final chart I want to go over is the Fed's fight against inflation. And I had an actual earlier conversation with a client this morning about that, about interest rates and things like that. So the effective federal funds rate is, once I get this chart up, is in kind of a blue color, and it's at 3.64%. And that's stair stepping down from last October. Last October is at a high of 4.33%, and it's stair stepping down to 3.64%. What has inflation done over that period of time? Well, since they started lowering interest rates back in October of 2025, the Fed, that is, lockstepping down, inflation continues to go down. And US inflation rate, based on what I have here, is at 2.4%. And so the Fed should continue to lower interest rates given that inflation is under control and steadily declining. Now, we'll see where it kind of bottoms out, but it's certainly below the 3% marker that it was at in October of 2025. So there's I've got a whole other, lots of other charts to go over, but I won't. I don't have time. But I do want to highlight just those few. And I think they're worth taking a look at. And you can check them out on my blog. All right, on to the next segment. So February 23rd, that is today. Today's morning capsule, the Aurora Report by Nigram Aurora, who I've been following a lot. I love what he wrote here, and I think he's spot on. What he says here is, note the following, and he has a chart that shows a rally in tech stocks when the Supreme Court decision came out striking President Trump's tariffs. In his interim capsule provided to members of the Aurora Report immediately after the Supreme Court decision now seems prescient. What they wrote was, the Supreme Court has ruled against the Trump tariffs, saying the president does not have the authority to impose tariffs under IEEPA. The stock market staged a vigorous rally in response. The Aurora Report analysis, the stock market response is short-sighted for the following reasons. And he lists 4 bullet points. The first is President Trump has several other options to impose tariffs. The second is tariffs are bringing in substantial revenue. Without tariffs, there will be higher deficit and more debt. And the third, the Supreme Court decision reduces the leverage President Trump has to negotiate with other countries. And then the fourth, corporations will seek refunds of tariffs paid, exacerbating the budget deficit. As an actionable item, there is no change in their protection band, which they put out. And if you're a member, of note is that at a time when Wall Street was issuing calls to buy stocks and the Momo crowd was aggressively buying stocks, which is Momo crowd is the momentum people that basically buy momentum and trends. The Aurora Report did not issue any buy signal for U.S. stocks and did not lower the proprietary Aurora protection band. The chart shows smart money sold the rally as the day progressed. As the Aurora Report predicted, President Trump later imposed 15% tariffs under Section 122 of the Trade Act of 1974. The chart shows that during the bulk of the rally, with the exception of late day short covering, the proprietary indicator was orange, indicating a net supply of stocks in spite of aggressive Momo crowd buying. The indicator is the most sensitive measure of net supply and demand in real time. The orange represents net supply and the green represents net demand. The chart shows the drop in early trade today in tech stocks as the stock market reacts to 15% tariffs. The chart shows the tariff line. Investors should carefully watch to see if tech stocks stay above this line or if they break below. If tech stocks stay above the tariff line, it will indicate that the Momo crowd is temporarily winning. In the Aurora Report analysis, Wall Street is wrong. Wall Street buying is based on the following. Okay, so the street is buying based on reduced uncertainty, lower inflation, lower interest rates, better relationships with other countries, higher earnings for companies, and company earnings juiced by tariff refunds. In a contrary call, Nigram Aurora and the Aurora Report analysis shows the following after the Supreme Court decision, actually. Higher uncertainty, higher interest rates, weaker dollar, higher budget deficit, higher national debt, U.S. losing leverage in geopolitics, tariff refunds delayed by years. The analysis also says the street is ignoring 3 elephants in the room. Tariffs were paying for about 70% of the recent tax cut. Without tariffs, the budget deficit will go higher. Tariffs were helping to rebuild the manufacturing base in America. Without tariffs, the hollowing out of the American industrial base will continue. And then the Supreme Court decision is a gift to China and Russia. So the Supreme Court decision will have a wide-ranging impact. And so he's writing and saying that this wasn't exactly a good thing to have happen because it makes the Trump administration and the pro-America industrial-based job way harder, and our economy is going to suffer because of it. And so it wasn't exactly a pro-American move to have that happen. President Trump will deliver his State of the Union address tomorrow. The State of the Union address will likely be market moving. Tariff uncertainty is good for gold and silver and many international stocks, such as India, Japan, and Vietnam. Basically, if you listen to also Treasury Secretary Scott Bessent, he was saying they anticipated this happening and they have other levers to pull. And they're going to be doing that. And if you ever, I need to pull what Scott Bessent said here, and maybe I'll dive into that next. But I thought that Negro Aurora should get some credit on having a contrary call to what Wall Street is doing, which a lot of times can play out very nicely for folks. All right, that's food for thought, and we'll move on to the next segment. All right, Morning Brew, February 22nd, 2026, their Sunday special. They wrote about private equity. Is private equity past its prime? So the lead-in says, do the names of Blackstone, KKR, and Silver Lake mean anything to you? Yes? Well, you're in the right place. If not, get ready to learn private equity, buddy. Since the mid-2000s, private equity investments have exploded into a multi-trillion-dollar industry with a hand in healthcare, restaurants, entertainment, and pretty much anything else you can think of. And yet, there are some signs that its dominance might be slowing down. So we're going to go over that. There's a good chance that the person who chastises you for not flossing answers to folks who can't stop talking about discounted cash flow. Private equity funds, or PE funds, now own a record number of U.S. businesses, from dentists' offices to car washes, national bookstore chains. Firms like KKR and Blackstone have armies of vest-donning management pros that raise money from pension funds and other institutional investors to buy companies, give them a bar rescue-style revamp, and eventually, hopefully, sell them at a profit. Over the last 15 years, the number of U.S. companies under PE ownership more than doubled, from just over 6,000 in 2010 to almost 13,000 as of the end of 2025, and they currently account for about 7% of U.S. GDP. As the industry's grip on the economy grew, so did the ranks of haters pointing out cases where funds saddled businesses with debt and conducted layoffs, leaving them with degraded service. Private equity economists, meanwhile, say that acquisitions have saved struggling businesses from bankruptcy, making them more productive, boosting employment, and delivering investors handsome returns. But now investors have soured on it. Private equity's heyday, when it paid returns that leave the S&P 500 in the dust, is roughly the investor equivalent of your grandparents' memories of when a gallon of milk cost a nickel. Rising interest rates in recent years have depressed the valuations of portfolio companies and made it more difficult for private equity funds to find buyers, delaying their ability to pay back investors. While company sales by private equity funds rose to almost 5% last year, the total proceeds from the sales declined by 21%. From 2022 to the third quarter of 2025, annual returns from an index of private equity funds were 5.8%. Only about half of the S&P 500's 11.6% during the same period, according to research from MSCI. In some cases, private equity funds have had to resort to controversial financial engineering, to return money to investors. Declining returns have made investors skeptical about shoveling more cash into the business buyout houses. Private equities funds raised 11% less money last year than in 2024, but signs of a rebound in deal-making are making industry giants optimistic. PE-owned Medline completed the biggest IPO since 2021 late last year. Retail investors to the rescue. So President Trump recently signed an executive order to make it easier for Americans' 401ks to invest in PE funds, saying that it would allow rank and file workers to capture the returns of these funds. But critics, like me, I actually am a critic of this, say that the industry needs Americans' retirement piggy banks more than they need private equity, arguing that private equity funds have far fewer transparency requirements than the stock market, and the management fees eat up the returns. I completely agree with that. I don't think it's good. Private equity's insatiable appetite for restaurants. So Subway, Dunkin', Arby's, PF Chang's, Denny's, Buffalo Wild Wings, Jimmy John's, Hardee's, or Carl's Jr., Auntie Anne's, Baskin Robbins, Cinnabon, Moe's, Panera, Bob Evans all share a common ingredient: private equity. Salt, too, probably. Between 2014 and 2024, PE firms invested $94.5 billion in bars and restaurants, CNBC reported, citing PitchBook data. And while that cash can be a much-needed boon for a growing restaurant chain, it can also be a major source of indigestion. The upsides of private equity: at its best, a PE investment can be like making a deal on Shark Tank. You get a big capital infusion as well as some expertise on how to scale the business, operate more efficiently, and grow the brand. One of PE's biggest success stories has been fast casual eatery McAllister's Deli, per Restaurant Business Online. McAllister's was acquired by PE firm Roark in 2005. By 2025, its system sales had grown 530%. Now it's worth more than $1 billion. But PE acquisitions can also be a recipe for disaster. Nearly half of the restaurant and bar chains that filed bankruptcy in 2024 were backed by private equity, per CNBC and PitchBook. Some of them were doomed, in part by classic PE tactics, like leveraged buyouts. That's when a PE firm borrows a ton of cash to buy a restaurant chain, then passes that debt on to the restaurant after the sale. Then there's the tactic that cooked Red Lobster: sale leasebacks, which involve a PE firm selling a chain's real estate out from under it, then making the restaurant pay above market rent. PE firms currently making bread. Blackstone acquired sandwich chain Jersey Mike's early last year for about $8 billion. Now the company is looking to go public at a valuation of at least $12 billion, reported Bloomberg. So there you go. The human cost of PE's healthcare boom. So private financiers have cannonballed into the medical space in recent years because, as your insurance company will never admit to you, healthcare is a highly lucrative business in the US, representing 18% of annual GDP as of 2024. To cash in, private equity has invested more than $1 trillion in healthcare companies over roughly the past decade, in some cases providing needed resources to strained hospitals and other medical facilities. But since the goal is to juice investors' returns, private equity is also notorious for doing almost anything in an attempt to turn a profit for owners. That often includes layoffs, which can have lethal effects in the industry tasked with saving lives. After acquisitions, PE-owned hospitals saw a 13% increase in emergency department deaths compared to similar non-PE facilities, most likely because of full-time staffing at these hospitals fell by 11.6% on average, according to a recent study co-authored by Harvard researchers. The findings track with previous studies linking staff shortages to higher rates of infections at PE-owned inpatient wards and more deaths at PE-owned nursing homes. Many nurses say they're stretched too thin to properly treat critically ill patients, and reports of dangerous supply shortages abound. In one highly publicized case, a woman died after giving birth at a PE-owned hospital that couldn't stop her internal bleeding because of the necessary supplies were repossessed for non-payment, the Boston Globe reported 2 years ago. That hospital was owned by Steward Health Care, a PE-owned company that was the largest private for-profit hospital network in the U.S. before collapsing into bankruptcy in 2024. That year, PE-backed companies accounted for 7 of the 8 largest bankruptcies in healthcare, according to the private equity stakeholder project Closures affect non-PE facilities too, since they're often forced to take an additional patients when a nearby hospital shutters. Some states are taking action. Last year, Oregon barred anyone but healthcare professionals from owning a controlling stake in healthcare businesses. Zoom out. Private financiers have similarly chased a boom in pet spending. At corporate-owned clinics, some vets have spoken of pressure to squeeze in more appointments, more morbidity. Staffing cuts caused freezers of deceased pets to pile up at some PetSmart stores after the company was bought by a PE firm in 2015, Vice later reported. You're not as invested in sports as PE is. So the New England Patriots made the type of history this year that you'll only read about in LinkedIn updates from your former frat bro in the B2B sales area. They became the first team backed by private equity to reach the Super Bowl and the first team backed by private equity to get bullied in a Super Bowl. Whether it's professional, college, or youth sports, private equity is getting to all areas of the game. There are 74 major professional U.S. sports teams with ties to private equity. The NBA has the largest proportion of teams backed by PE, 20 of the 30, while the NFL and NHL have the lowest, with 10 of their 32 teams, respectively, having PE connections. PE, or private equity, made its first venture into college sports in December when Otro Capital struck a deal with the University of Utah. Youth sports have also garnered attention, with PE investing in facilities, leagues, and uniform manufacturers. The attraction of pro sports is easy to understand. With recent team valuations rising well into the billions, the pool of people who can afford a stake is getting shallower. The $6.1 billion sale of the Boston Celtics to Bill Chisholm last year included a $1 billion investment from Sixth Street, a private equity firm that also owns a stake in Major League Baseball's San Francisco Giants. Waiting and seeing with college sports. So firms and schools will be keeping a close eye on how the Utah Otro deal works as the NCAA navigates a wild west of NIL rules. Otro's reported $500 million investment, which includes help from donors, will allow it to manage several Utah athletic operations, including licensing and media. Youth sports. Really? Really, youth sports? Ask any parent who has had to drag their kids across state lines for an all-day lacrosse tournament about how expensive it can be. In recent years, firms have poured billions into TeamSnap, a platform that facilitates the scheduling of games, varsity brands, an apparel maker and organizer of cheer competitions, and MIG Academy, a boarding school that has graduated many future professional athletes. What else does private equity own? Well, media. You might think you're pretty good at following the money through the ruins of a Red Lobster, but PE firms have expanded their investment portfolios to include things you didn't even know were for sale, such as vital ferry lines for the Isle of Wight and gas pump screens. So here's what else you didn't know private equity owned. Font libraries. In 2019, private equity firm HGGC bought Monotype, the company behind pretty much every iconic font you can think of, for $825 million. Monotype has since hoovered up other typeface companies like its 2003 acquisition of Frontworks, which was popular among Japanese game developers. Last year, Monotype discontinued its $380 yearly licensing plan and rolled out a new one for $20,500. Your tunes. The quickest way to substantial cash for megastars is selling their music catalog. One Republic frontman, Ryan Tedder, sold a majority stake in his 500-plus songwriting catalog to PE firm KKR for $200 million in 2021. You either die buying or live long enough to become the sale. London fund Hypnosis, which scooped up back catalogs of artists like Blondie and Jason Bieber, was acquired by Blackstone for $1.6 billion in 2024. Screen time. Cocomelon, Colin and Samir, Dude Perfect, and Economics Explained are just a few of the powerhouse YouTube shows and channels that have sold to private equity as the industry targets the low overhead, personality-driven media. So I thought this was a great Sunday special piece by The Morning Brew. thank you, Morning Brew, for putting that out. I think it's really important for people to understand what's going on behind the scenes, who's driving it, and how much money is being spent to buy or to sell, and how we're being nudged in certain directions through marketing, advertising, through sports and media, art, and everything else. This is only going to accelerate as I think AI is going to drive more and more of this type of thing. So thank you, Morning Brew, and its editor's notes and its staff writers there for this informative piece in the private equity space. There you have it.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.